when ETH was ripping and Tom Lee announced his 20 billion at the market facility, and, you know, that was late summer, right? That was a crazy time, very euphoric. Like, I would argue that was a banana zone, right? And I had to step back and be like, wow, I feel really good. People around me feel really good. People on Twitter feel really good. Like, that's just a time to be taking some profits.
If you'd have looked at that liquidity chart, would have told you the same thing, which is liquidity wasn't going up fast enough for the market to accelerate. And the reason being is it was exactly then in July when the M2 chart decoupled, all of these charts decoupled. And we're looking at this thinking, what the fuck is going on? And we realized for us, the explanation is it was the TGA rebuild. Suddenly they started ramping up the rebuilding of the TGA, which was withdrawing liquidity, and there was no reverse repo left to drain. So suddenly it was a big event. And then we had the government shutdown.
Sometimes the crypto market leaves even the sharpest minds second-guessing themselves. And right now, that's exactly where we are. This cycle has broken almost every familiar pattern. Price action is sluggish, liquidity reads are confusing, correlations have slipped, and even seasoned analysts are starting to wonder, did we already miss the real momentum? If you've been feeling that same uncertainty, you're not alone. In fact, today's conversation between two of the most influential analysts in the industry, Raoul and Chris Burniske, captures that doubt perfectly. One of them thinks the next big move is still coming. The other believes it has already passed. Raoul, as many of you know, has been calling for an elongated macro-driven cycle, one he believes will peak in 2026, 2 full years after the 2024 halving. For months, he's argued that liquidity is the spine of every major crypto expansion, and that the liquidity wave for this cycle simply hasn't arrived yet. But even Pal, as bullish as he is beginning to question his own timing. The signals aren't lining up the way they normally do. The usual correlations are breaking, and the market feel, as he puts it, is sloppy. If the most optimistic liquidity analyst in the space is openly entertaining doubt, you know we're in a strange moment. But on the other side, we have Chris Burniske, measured, analytical, and willing to say what many traders have whispered for months. Maybe the cycle actually ended back in 2024. Burniske argues that the euphoria we saw during the summer, the Ethereum rip, the ETF frenzy, the aggressive pumps across the majors, was the peak. Not the beginning, not the warm-up, the peak. And if he's right, then this isn't the setup for another bull leg. It's the early phase of a broad, grinding come-down. Even if that's painful to hear, it's a perspective we can't afford to ignore, especially given how complicated the last year has been. And so today's video is built around a simple but important question. What if we really already missed the banana zone? What if the parabolic phase, the one everybody was waiting for, was already behind us? I want you to hear Burniske's caution with the seriousness it deserves before we shift later in the video to Raoul's full liquidity framework and why he still believes 2026 will deliver the blow-off top. So if you want the complete picture, not just hopium, not just pessimism, I encourage you to watch until the end. And of course, before we dive in, please hit the like button, subscribe if you haven't already, and let me know in the comments where your gut is leaning right now. Now, before we get back to the video, I want to take a moment to talk about another market. I am extremely bullish on the copper bull market. It could be the biggest bull run we've seen in a while. Historic events are happening. We are even seeing the US government take stakes in copper companies. It's the #1 most important metal for our future. It's used in AI, data infrastructure, defense technology systems, communications, electric vehicles, and many more. It powers our future, and there is a massive shortage. Trump has made it clear, copper is 100% essential for the future of our national security. That is why I have waited until today to present our sponsor, Copper Giant Resources, ticker CGNT in Canada and LBCMF in the US. Now, why is the US all of a sudden so interested in copper and securing its supply? This year, China's share of global refined copper production will hit 57%. China dominates copper refinement, and if this continues, the US and Western world is at a massive disadvantage. This positions Copper Giant Resources perfectly to benefit from the demand. The US needs an ally country, a country on the Western Hemisphere. Copper Giant owns 100% of the Mocoa Copper Project, located in the Andean Belt in Colombia. This is one of the world's richest copper jurisdictions. Early interest has already shown. The company's CEO, Ian Harris, was invited to the U.S. Embassy in Bogotá to discuss shipping concentrate to U.S. refineries instead of China. This is the kind of setup you only see when policy, politics, and resources collide. People should seriously be looking at Copper Giant resources. To learn more, visit the link in the description. Again, this video is sponsored by Copper Giant Resources. Do your own due diligence. Alright, let's get into it.
In kind of the simplest framework where, and this is the 4-year cycle framework, then Bitcoin is in the process of topping if you follow that 4-year framework, right? And then you would expect a bottom about 12 months from now. And you could say that that's due to halvings, which I think it's more dubious as Bitcoin's inflation rate diminishes. And you really think about the crux of the halving argument and, you know, the amount of coins that goes to miners and proof of work and the cost to produce Bitcoin and all that. So there's the halving argument. There's the liquidity argument, which you've done a great job of educating people on, you know, and Bitcoin kind of aligning with 4-year business cycles, and then the liquidity cycle on top of the business cycle. This is where it gets tricky, right? Because right now Bitcoin is deviating a bit from the liquidity cycle, right? And so I think we have to acknowledge, for me, that is a point of paranoia, right? Where I'm like, hey, the liquidity cycle would suggest that Bitcoin should at some point here do very well. Right now it's struggling a bit, but I can't ever get too confident in that view because I know that I could get my face ripped off if I'm not allocated enough to the upside, and, you know, liquidity dynamics kick in. But I would say kind of for me, overarchingly, the reason I started to sound some caution, let's say, after really the 1010 crash, was the market was just feeling heavy to me. And there was someone who put a comment on crypto Twitter of, you know, one way in which I look at markets is kind of as an organism. And I'm not as, kind of like focused on some pinpoints, and I'm not as deeply trained, for example, as you are on some of the detailed nuances of markets, right? And so then what I'll try and do sometimes is just step back and look at the organism as a whole and take in all those variables and say, okay, what is the mix of these variables suggesting? And so for me, you know, we started to feel weird when, really Solana was not getting that much of a bid from its DATs and then anticipation of its ETFs, right? So you kind of had, you know, you had Sailor and the Bitcoin DAT bid, which then went into the Ethereum DAT bid. You also had the Bitcoin ETFs and the Ethereum ETFs. Those two, you know, those events were phenomenal for Bitcoin and ETH. You would have then expected the similar events to also be phenomenal for Sol, which, you know, for me has been kind of the high risk asset of choice this cycle, right? And you've focused on Sui, I focused on Sol, pretty similar.
I had Solana earlier on and then did the switch, but yeah, completely.
Right. But like just thinking of a high performance L1, great, you know, core engineering, interesting ecosystem. And so then when Sol was heavy through the DAT anticipation and then the pipes getting announced and kind of the announcements of those vehicles, and then heavy with the ETFs, that started to feel very weird to me, right? It's like, well, there's not a bid here and there's clearly a lot of selling if Sol's not rallying. And then that 1010 liquidation, I mean, the only thing similar that I've seen was March of 2020, the COVID crash, you know, and you had assets. Like I looked at the portfolio, that day and, you know, assets were down 60 to 90% on the day at a point in time. It was insane. And so what I didn't like about that was, okay, this cycle, there's been a lot of angst around, really in the long tail, right? Where's the bid in the long tail? What's the fundamental value in the long tail? How do you value these things? I would say things that we have anticipated for a long time, right? Like the professionalism of valuing crypto assets. And you and I have both, been early to trying to figure that out. Well, it's coming now, right? And so the long tail's not getting a bid. There's an AI bubble. And then the 1010 crash revealed for a lot of assets where an organic bid materialized. And my paranoia in those wicks is, do we have to go back to those wicks, right? And some of those wicks suggest, bear market levels of where, especially in the long tail. I try and go with, hey, this time isn't different until there's a strong enough reason for it to be different, right? And we see that play out in all kinds of ways, right? And the reason things are never different is because human nature never changes, right? And you and I know that well. There are a lot of reasons for this time to be different though, right? Like there's, sweeping, legislative action and regulatory clarity in the US. There's major, traditional finance and traditional tech embracing of stablecoins and blockchain technology. There's ETFs in the market for the majors for the first time. Liquidity is coming our way. So there's a lot to suggest that, we could turn a corner here. And I'm prepared for what it's worth. Like BTC right now is 98. ETH is just above 3K. Sol's 140. I'm prepared for things to turn around from here. It's possible.
Yeah, because remember 2021 was a wild one for that. I mean, BTC went down 50% and then straight back up. I mean, that was not easy.
Yeah, and so like here you're looking at BTC down 20% from its highs, ETH already down about 40% from its highs, and depends on which high you want to use for Sol, but from the December 24 high, Sol's down about 50%, right? I could see that being enough of a washout. I could see that if we rally from here, I could see that being very painful for a lot of people. If we step back with this cycle as a whole, right? Most assets bottomed December-ish of 22, right? And then 23 kind of wobbly until October of 23. From October 23 to the end of Q4, we ripped. And that was alt season for most coins. End of Q1 24, after the Bitcoin ETF gets approved, Bitcoin's, doing well. Everything's doing well. Everyone's hopeful. Everyone's like, oh my God, this is all going to happen again exactly as it happened last time. That was the peak. End of Q1 of 24.
Burniske's framework starts from something every experienced investor eventually learns. Markets behave like organisms, not machines. And when he steps back and looks at the organism of this cycle, he sees a market that peaked early, became top-heavy, and has since struggled to find real organic bids, especially outside Bitcoin and Ethereum. You may agree or disagree with him, but he's not speaking from emotion. He's speaking from structure. Solana failing to react to its own catalysts, long-tail assets collapsing to March 2020-style wicks, ETF anticipation producing diminishing returns, all of that reinforces his view that the engine of this cycle may have already run out of fuel. And if you've been trading through the constant heaviness, the stop-and-go rallies, and this strange sense that momentum keeps evaporating, you might feel the weight of his argument more than you expected. But this is where Pal enters with a completely different lens, one grounded not in market feel, but in macro sequencing. To him, nothing about this cycle's sluggishness is surprising. We're in the trough of a business cycle that was pushed out by post-COVID rate dynamics, and the real liquidity expansion, driven by debt refinancing, fiscal push, and global synchronized easing, isn't due until 2025 to 2026. United States Secretary of the Treasury Scott Bessent has been saying the same thing. Main Street hasn't gotten the liquidity yet. Markets feel sloppy because we're early, not late. So for Pal, the question isn't, has the bull market ended? It's, why would it even start without the liquidity wave? That framework leads directly into what you're about to hear from him next.
So how my framework, one of my big lessons learned is every time I override a kind of macro framework with emotion is when I've kind of got it wrong really badly. 2009 was my worst year because of that. And so I've got this very robust framework called the everything code. Again, probabilistic, because I'd say, well, you say seriously, there's many other outcomes that can happen. But I got to this weird thing where I started realizing that the ISM, the business cycle, was a perfect 4-year cycle until recently. I'm like, what the hell is going on here? What's gone wrong with this cycle? And the work that I'd done was, this was all a 4-year debt maturity cycle. And because in 2008, we had a debt jubilee and everybody forgave interest payments for 4 or 5 years. And what they did was restructure their debts. So this 3 to 5 years cycle, and we got this perfect cycle. This is the Bitcoin halving cycle. This is the whole thing. And then suddenly it stopped. And I'm like, interesting, because I calculated this 4-year debt cycle. I think I was the person who discovered it. So I went back and recalculated. And what I found was in 2021 and 2, because rates went back down to 0, they pushed it out another year. So it got to about 5.4 years. So I'm like, okay. So then when I put it back on a little sine wave, you're like, oh, that sort of makes sense. So we're still in the trough of the cycle, and we should be coming up with the business cycle growing, because we've not had it grow. And then out of that, I've obviously been using liquidity as the main driver of all of this to finance the debt. So here's the interest payments that come due, and here is the liquidity to match it. And this is total liquidity in the US. So that's the Fed net liquidity plus banks and M2. And so that's where the money has to come from to finance the debts. Okay, so it makes sense. And then when you look at it, how I use it is financial conditions, which for us is the dollar, rates and commodities, leads total liquidity by 6 months, which leads ISM by 6 months or 3 months. So you've got this 9-month lead of financial conditions, which suggests that liquidity should pick up and the business cycle picks up. So that's the framework we've been using, and it's very good. So I'm like, okay, this is interesting. It's persistent over time. So we know that the ISM, so liquidity is the main thing. The ISM is the driver of the economy, and financial conditions give us the lead. When we detrend Bitcoin and put it against ISM, it's the same thing. So what it's telling us is Bitcoin is subdued because of the business cycle. And the reason the business cycle is subdued right now is because it's not the debt rollover year this year. It's next year. It's the next 12 months. So it's like, oh, okay. So the debt rollover year is the thing that makes the difference. And then you look at the correlation between, this is global liquidity. So we're assuming all countries do it. It's pretty closely correlated. And we've seen global liquidity picked up and it's pulling back down. And that gives us an R squared of 90% and 97.5% versus the NASDAQ. So it's like it's the most dominant macro factor in history, driven by the debt refinancing cycle, and the business cycle is a component of it. The business cycle has been lackluster for a number of reasons. And then when I look at this is US total liquidity against the crypto total market cap X Bitcoin. And basically it's the same thing. Now, recently we hooked lower because of this lack of liquidity. And this has been slightly overvalued. And every time we've got there, we've kind of caught up. And so the bet to me is, if I extrapolate all of this away, the question is liquidity going to have to rise because of this or not? Because if it is, the correlation of liquidity is so high that I would be ignoring the biggest macro factor we've ever been given, and nothing would work. And then I go, the other way I think about this is, okay, well, the business cycle, if Scott Bessent talks all day about we need to get Main Street to have money, and we've got a stimulus coming in terms of fiscal, and we need to get, Main Street catching up with where Wall Street's been, that tells me the business cycle needs to go up. Earnings need to go up. Corporate earnings, household earnings, and not just the Mag 7. So if they want to win the next election or the midterms, this is the game to goose. And what's interesting is Scott Bessent's a macro guy. So that's what's in my head. And I find it hard to walk away from all of that. But I also see that the structure's not great and the markets are sloppy and all of the things that you say.
Well, it's your own paranoia, right? We basically have opposite
That's why I
paranoias.
wanted to talk to you. That's why I wanted to talk to you, because I wanted to hear I want to hear the paranoia, because I can confirm my view to myself all day.
Yeah, of course.
But I need to hear the whispering voice in my head to say, no, Raoul, you're a moron. That's the most important voice.
It wouldn't surprise me if you're right, but you're just a little early, and it's the debt refinancing year is 2026, right? And
well, it is. That's the point. So it's kind of, I can't see how we get a bear market unless all liquidity leaks into an AI bubble or something else.
Both analysts are looking at the same market, the same data, and the same price action, but they reach radically different conclusions. Burniske believes the market has already shown its hand. The early euphoria, the ETF front run, the 10-10 liquidation event, the long tail weakness, all classic signs of a cycle that ended earlier than usual. It's an argument based on internal market structure, declining marginal buyers, and the simple observation that crypto hasn't behaved like the 2017 or 2021 templates. For him, caution isn't pessimism, it's adaptation. Powell's thesis, on the other hand, is built on macro inevitability. If liquidity cycles are the engine of every major asset run, and if the global liquidity expansion hasn't arrived yet, then the bull market simply cannot be over. His model says the peak isn't behind us at all, it's ahead of us, and not just slightly ahead, but potentially 2 years beyond the halving window. In his view, 2024 to 2025 was the warm-up. 2026 is the main event. And realistically, both perspectives matter. There is structural weakness right now. There is unusual slippage between liquidity and prices. There is a sense of heaviness across most assets. But there's also a global easing cycle forming, a debt rollover wall approaching, and a wave of institutional rails, from stablecoins to tokenized assets to ETFs, that fundamentally didn't exist before. You don't have to pick sides today. What matters is understanding the forces pulling the market in both directions. So as we wrap up, I'd love to hear from you. Do you think the banana zone is still ahead, or did we already live through it without realizing? Let me know your take in the comments. If you found this breakdown valuable, please like the video, subscribe to the channel, and share this with someone trying to make sense of the cycle. Thank you for watching, and I'll see you in the next one.